In the early 2000s, a quiet but momentous shift took place in Southeast Asia. For decades, the Philippines had enjoyed higher GDP per person than its much larger neighbor Indonesia, a legacy of colonial ties, political paths, and economic policy. But by about 2003, Indonesia's GDP per capita crept just ahead of the Philippines. This milestone, noted by analysts and the press, was more than just a number. It signaled a long-term divergence in fortunes. Indonesia, once far poorer per head, had implemented policies and reforms that drove growth. The Philippines, despite steady growth, had not kept up in per-person terms. World Bank data shows that in 1967, the Philippines' per capita income, about $223, was more than quadruple Indonesia's, $53.2. But by 2003, the tables had turned. After decades of relative stagnation, Indonesia's GDP per capita finally matched and slightly exceeded the Philippines' level. Data shows that in 2003, Indonesia's nominal GDP per capita was about $1,043 versus $1,027 for the Philippines. By 2023, the gap has widened. Indonesia approximately $4,876 versus Philippines approximately $3,805. But why has that been the case? Why has the Philippines, despite having 4 times the GDP per capita than that of Indonesia, have fallen off? Well, let's unpack everything starting with history. In the decades following World War II, the Philippines and Indonesia followed very different paths. The Philippines, soon after independence from the United States, 1946, initially experienced relatively stable growth and industrial development under leaders like Ramon Magsaysay. It had close ties to the US, substantial aid flows, and a head start in education and industry. In contrast, Indonesia became independent from the Dutch in 1949 only after a guerrilla struggle, and then fell into political turbulence under President Sukarno. By the early 1960s, Sukarno's guided democracy was failing. The economy was in crisis with hyperinflation, around 1,000% annual inflation by the mid-1960s, stalled exports, and collapsing infrastructure. Suharto's 1965-66 takeover, the New Order regime, was partly a response to that chaos. As a result, by 1967, the Philippines was already noticeably richer per person. The World Bank data shows Philippine GDP per capita around $223 versus only $53 in Indonesia. The Philippines' per-head income remained higher through the 1960s and 1970s. In the Philippines, GDP rose from about $5.9 billion in 1964 to $42.1 billion by 1982. The economy grew at healthy rates in the late 1960s, in part driven by high global commodity prices, e.g., sugar and coconut. Indonesia, by contrast, lagged behind. Under Suharto's early rule in the late 1960s, the priority was macro stability. The new government imposed fiscal discipline, restructured debt, stabilized the rupiah, and invited foreign aid and investment. In the 1970s, Indonesia caught an oil bonanza. World oil prices quadrupled in 1973, and Indonesia pumped more oil and gas. Those hydrocarbon revenues funded infrastructure roads, ports, electricity, and public services, and helped keep the economy growing. But initially, per-person output was low. Indonesia's GDP per capita in 1974 was only about $200, compared to the Philippines' approximately $379. By 1980, the gap was still large. Data show that in 1980, the Philippines had nearly twice Indonesia's per capita GDP in US dollars, about $767 versus $486. Economists at the time often viewed both countries as part of a second tier of Asian economies, behind Japan and the Four Tigers. But clearly, the Philippines had the edge. Part of this was demography. The Philippines had fewer people, about 50 million in 1980, and more urbanization compared to Indonesia's rapidly growing population, 148 million in 1980, scattered across many islands. In political terms, the late 1970s set the scene. Ferdinand Marcos imposed martial law in the Philippines, 1972 to 1981, consolidating power, suppressing dissent, and establishing crony economic systems. Initially, there was some growth under martial law, but much of it was financed by foreign borrowing. When global interest rates rose and export markets slowed in the early 1980s, the debt-heavy economy cracked. In contrast, Suharto's Indonesia remained authoritarian, but focused on technocratic development. The new order cultivated a few pro-growth policies: investment in agriculture, the Green Revolution, expansion of schooling, and encouragement of manufacturing, textiles, footwear, consumer goods. By some accounts, Indonesia in the late 1980s was called an East Asian miracle, or a high-performing Asian economy in IMF World Bank jargon. The contrasting approaches of Marcos and Suharto became especially evident in the 1980s. In the Philippines, the massive debts accumulated in the 1970s for infrastructure and military spending came home to roost. World Bank analysts later noted that GNP growth in the 1970s was achieved at a high investment cost, and by the early 1980s, the Philippines faced its worst recession ever. Indeed, GDP growth plummeted in 1984 to 85, shrinking by about 7% per year. Investment dried up and widespread poverty returned. The external debt skyrocketed from $360 million in 1962 to over $26 billion by 1985, and the peso lost value, falling from approximately 4 to 1 to the dollar in the 1960s to over 20 to 1 by the mid-1980s. In short, by the mid-1980s, the Philippine economy was in deep trouble. Growth was minimal or negative, and social indicators worsened. Indonesia had its own challenges in the 1980s, notably the fall in oil prices in 1982 to 83. Because Indonesia had depended heavily on oil revenues, the early 1980s oil price collapse was a shock. Growth slowed, and the government had to devalue the rupiah and cut spending. But by contrast to the Philippines, Indonesia's policy response under Suharto was reformist. Agriculture subsidies were cut, the private sector was liberalized, and the economy diversified. The government also continued to invest in basic industries and infrastructure. By the late 1980s, Indonesia was able to rebound to healthy growth again. Indeed, an RBA analysis notes that Indonesia's manufacturing share of GDP nearly doubled from 8% in 1967 to about 13% by 1982, and then continued climbing to over 26% by the late 1990s. Agricultural share fell from 51% in 1967 to 23% in 1982. In plain terms, Indonesia's economy shifted from being half agrarian in 1967 to much more industrialized by the 1990s. This structural change underpinned faster growth and rising incomes. The strict politics of Suharto's regime, though often corrupt and repressive, provided stability and the capacity to carry out economic plans. According to one observer, the legitimacy of Suharto's authoritarian rule lay primarily in the economic development that took place during its reign. Millions of people were lifted out of poverty. By contrast, the Philippines in the 1980s was seen as a stalled economy trapped by cronyism. The divergence of the 1980s set new baselines. By 1993, Philippine GDP per capita, nominal, was about $918, which was a small improvement from 1982, about $832. In contrast, Indonesia's per capita GDP had climbed to approximately $817 by 1993, up from $577 in 1982. So, despite starting behind, Indonesia had increased its per capita in a decade, while the Philippines had little net gain. The stage was set for the 1990s to widen the gap further, until the Asian financial crisis reset things again. The 1997 to 98 Asian financial crisis was a pivotal shock. Both the Philippines and Indonesia were swept up in the regional turmoil, but Indonesia was hit much harder. When Thailand's baht collapsed in mid-1997, investor panic soon spread. The Indonesian rupiah fell sharply. By late 1997, it had lost about 60% of its value, and by early 1998, about 80%. The credit and banking system went into crisis. Real GDP plunged by an estimated 13% in 1998. Politically, the turmoil toppled Suharto in May 1998 after 32 years in power. In the wake of the crisis, Indonesia enacted significant reforms. Politically, the country moved from Suharto's authoritarian rule to democracy. The 1999 elections were held and followed peacefully, and a major decentralization law, 2001, shifted budget authority to thousands of regions. Economically, the government recapitalized banks, strengthened regulations, and gradually reduced subsidies. It also maintained prudent fiscal and monetary policies. Inflation fell from the hyper levels of 1998 into the single digits, and debt per GDP began to decline. Foreign investment flowed back in, drawn by Indonesia's huge domestic market and commodity wealth. Oil prices rebounded, and minerals like coal, copper, and palm oil boomed. By 2004 to 2005, growth had accelerated to roughly 5 to 6% per year, helped by rising exports and domestic consumption. The International Monetary Fund noted that, since 1999, the economy of Indonesia has recovered, and growth accelerated to over 4 to 6% in the early 2000s. During this period, Indonesia also benefited from the global commodities cycle. As a major producer of oil, gas, coal, palm oil, tin, and nickel, Indonesia saw its export revenues surge. This windfall further expanded government spending on infrastructure roads, ports, electricity, and education. The poverty rate, which had shot up in 1998, declined steadily after 2000. By 2008, only about 19% of Indonesians were below the poverty line, down from over 60% during the crisis years. Meanwhile, foreign institutions dubbed Indonesia the second fastest growing G20 economy by 2012. The Philippines, too, enacted reforms after its own crisis. In 2001, it faced a financial shakeout of its own, the peso crisis and Estrada's impeachment, but ultimately returned to growth. President Arroyo's tenure, 2001 to 2010, saw improved fiscal management and an eventual acceleration of growth, averaging 5 to 6% in the latter half of her term. The Philippines also benefited from technology demand, especially semiconductors, and a boom in business process, outsourcing, call centers, fueled by a skilled English-speaking labor force. Remittances from overseas Filipino workers became a huge source of foreign exchange and household income, over 10% of GDP by 2010. The year 2003 is often cited as the first time Indonesia's per capita output exceeded the Philippines. Official statistics confirm it. In 2003, Indonesia's GDP per head, nominal in US dollars, was about 1,043, compared to about 1,027 for the Philippines. What made 2003 the tipping point? It was not a single event, but the cumulative effect of years of policies and growth. One observer noted that this was linked to poor governance and protectionist policies in the Philippines. Others noted that the Philippines had simply not grown fast enough to keep its lead. From 2000 to 2003, the Philippine economy grew about 2 to 3% per year, whereas Indonesia grew closer to 4 to 5%. Over time, even small differences add up across millions of people. But anyway, do let us know what you think. Thanks for watching.